and welcome to another awesome chapter in the saga that we know as Accounting 2301. We are bringing you chapter number 8, and I will tell you it is great with your good old-fashioned host of Professor Naragon. Now, 8 is going to bring you our third really big type of asset. Now, in chapter 6, we dealt with cash. Chapter 7, we deal with accounts receivable. In chapter 8, we now get to deal with actual fixed assets. Now, these assets are basically known as long-term assets that are anything that's basically we're going to keep for a very long term, and it's going to be used in normal operations. So we have to watch out if it could be an investment or not. We basically classify these as normally property, plant, and equipment. So again, basically buildings, any factory, any equipment involved in the normal operations. So again, as an example to this, one, if I have a construction company and the owner decides to buy a boat, well, construction usually does not use a boat, and we're going to say this one's got commercial construction, all land-based. So the boat's not in normal use. So if I look at this chart, one, a boat, that item is long-term. But, so when we go to step 2, is it used in normal operations? A boat is probably not in a construction company, so I would go no. It's going to be considered an investment. The company's probably going to sell it later on. Probably not going to make much either, but we're going to have our fun. But let's take this construction company. They decide to buy a crane that they need for a skyscraper. Well, crane's going to be with the company probably for a long term. So yes. Step 2. Is it used in normal operations? Yes. And that's going to be considered a fixed asset. The thing is, accounts that we have to basically understand with fixed assets is that they have to follow these 2 steps. They have to be long-term and they have to be in normal operations. The most common mistake is that we don't treat them as normal operations, and accountants must understand the business. Okay, that is our main goal. If you're going to become a CPA or even just run your own business, you have to understand fixed assets have to be a part of normal operations. Now, inventory as itself is not basically held for resale. It is there just to be used, and fixed assets inventory is not. They're basically, we do make stuff. Some manufacturing companies may make something out of their inventory, but as long as it's not held for resale, it can be also considered fixed asset. So that's a cool little thing. We make our own stuff. We later get to do what we always do, and that is depreciate it. So we do want to depreciate it, and this is going to bring us back to chapter 3. So you're going to hear another term when they're talking about depreciation, and that's basically costs to be capitalized. Okay, when we're capitalizing something, basically it's going to be used for depreciation purposes to help that asset. When we're dealing with fixed assets, any cost that is going to be to help that asset be put into place and get ready to be used is going to be part of the depreciation value, or basically the total value for the object, whatever asset that we have. So, for example, when we're looking at freight, installation costs would probably be included. But for assets that are constructed and not bought, costs may include labor, materials, and stuff that we would have to actually capitalize. This chart is actually very good. This is going to bring us basically 4 types of assets, you can say, fixed assets. One is building. As you can see, all these get capitalized because it helps us get the building ready to be used. Now, it's going to be a little bit different if it's repurposing, but here again, reconditioning, purpose of existing building, modifying for use, any permits, repairs if it's an existing building. All of this helps it get ready. So anything that deals with the building process. Machines and equipment. We'll also have to look at sales tax, freight, installation, so installing it in our factory. Any repairs if it's a used equipment. Again, maybe we repurpose it. Insurance. Assembly, modifying for use, testing for use, permits. So again, until that equipment is actually producing on the sales floor or the production floor, on the assembly line, any cost that is there to get it ready to do that, we must capitalize. Land has also its own. So again, sales tax, any commissions, title fees, surveying. And now, you have to watch out, that's to land. Anything that's land improvements, basically to make the land look better or have it better for us to basically not land itself. I mean, adding trees and shrubs. I mean, adding a fence. So that's not really part of the land. That's something we can easily remove. Parking lots, it's a little bit harder, but you can still remove a parking lot. So when we're looking at anything that's a land improvement, basically it helps the land get ready to be used. So again, land is going to be the one that doesn't depreciate, but land improvements will. So stuff that's outside the normal course of business, such as fines, mistakes, theft, they are not capitalized. Again, this is through normal use. Okay, so when we're looking at this, say that we need a machine very quickly to get something done that's going to make us about $1 million. So we're calling the truck driver or the shipper and go ahead and run all those red lights. Just get here ASAP so we can get this machine and make this money. Well, and you go, we're going to pay all the fines and all that stuff. So the guy runs the red lights, gets caught by the cops, and gets the ticket. Well, the ticket's not part of the normal course of shipping a product. We rush the shipper. So that's something that's not going to be part of it. Well, mistakes do happen also. Say somehow when you're doing, let's see, you're installing something and the part actually goes missing. It was in the box, but all of a sudden it went missing, or you left it somewhere and it got damaged. Well, that's a mistake. Buying the new part to get it going, or repairing that part, will not be part of normal course. You already had the part, just somebody messed up. So we can't capitalize that. That one actually will be an expense. So some things we get capitalized, some things we don't. So we're going to get probably like example or two in your homework that deals with that. But it's just understanding if it's a mistake or theft, someone actually stole something, they're not capitalized because it's not part of normal course of duty, getting the asset ready. Okay. So dealing with revenue and capital expenditures, or basically expense. Should we expense or should we not? The big one right here is the repairs. Okay, when we're dealing with fixed assets are in its term an asset that's for a long time that does eventually break down. The only exception to the rule is land. Well, machines, buildings, and all those will eventually have to have repairs done to them. So the question is the repair an expense, or is it something that has to be capitalized? Well, first off, if it's an expense, I'm going to put an example for a big rig. So, trucking company. Okay, so we purchased a big rig. We've had it for a few years. Now, every year we have to actually replace the tires on it. Tires is part of the vehicle, but it's only during that current period. Tires only last for the year for most trucks, so most big rigs and shipping. That's why we see all the rubber along the ground. But with that, since it only benefits that current period, that's known as an expense. Even though replacing the tires is considered repairs on it, kind of like replacing the oil. You'll probably replace the oil like every year, oil changes. Those are considered ordinary repairs and maintenance. They only happen during that year. So they're not something like too big. Okay? Now, on the other hand, let's say the transmission broke down. Transmission's gone on our big rig. So right now the asset's basically useless to us. The truck's useless. So we decide to go ahead and repair that transmission. Well, repairing the transmission is going to extend the life of this big rig. It can run further now. Transmission's been repaired. Same thing if we had to replace the engine. When it replaces something that big, because you're going to look at costs mostly. IRS looks at costs, audits look at costs on these things. If it's a big amount, they're going to probably want you to capitalize. But when we're looking at this, when an engine or transmission goes in a vehicle and we decide to repair it, that is going to be known as an extraordinary repair. And this is going to actually extend the asset's useful life, and it's going to basically revise depreciation for those periods. Again, the life got extended. So it does say debit accumulated depreciation, which we are going to, mostly because we're going to have to revise all the depreciation. So depreciation is not the same because it's been extended. So we're going to have to do a little adjustment when those situations happen. When it's the other way, so you see this arrow going to asset improvement. Well, with asset improvement, this is saying, we took our big rig, and our big rig is now going to be used for, basically, we're going to turn it into a huge tow truck. Let's say that. One of those like big old 18-wheeler tow trucks that you actually see going around. So we're going to basically, we had the big rig, and we're going to add all these new parts to it. We're basically changing almost the purpose of the item, but what we're doing, we're actually improving it. So when we're improving it to be able to tow, it does add basically what is known as service value to the asset, which then we would have to debit the fixed asset. So anytime we actually do a big improvement, say again, like you take a regular vehicle and you decide to put fog lights on it, you put all the big old fancy lights, the bar grill, that stuff to basically improve it, to make it better. It's extending the life. It's extending the value, you would say. The value of it. So we're going to also mess with depreciation, but we would actually debit the fixed asset. So those are just a little bit off on which way it goes, but consider this again. If it improves the asset, it's going to add to the value of that asset. If it's a crazy repair, again, this one's going to extend the useful life of the asset. So there's some fun stuff here. We're not going to get too heavily involved in this. Again, this is more like intermediate accounting, but I wanted to actually explain the situations, the thinking of this. So most of the time, any of those situations in the real world, you're probably going to debit the fixed asset and not touch accumulated depreciation until we revise. But for our book, you will have this. I don't remember it being too much involved in the actual homework and exams or quizzes, but that's just a rundown of what happens with repairs. Okay, so again, this is income statement right here. This is all dealing with the balance sheet. Okay, so let's get into the big bad boy of chapter 8. Big bad boy is depreciation, and yes, we did have this in chapter 3 as an adjusting entry, so you've been exposed to it, but here we actually get you a little bit more in depth, a couple more basically ways to depreciate. So again, a lot of assets do lose their value or function over time, and they basically wear out. The only exception again is land. So depreciation, its basically definition, is a systematic transfer of asset cost to expense over time. Again, the IRS and the SEC, GAAP, they all tell us this. When we do these big purchases, we are not allowed to take the whole cost in that year, since technically we haven't used up that cost. Again, this is that expense recognition. So depreciation is basically recognizing the expense recognition of using up that asset. Okay, so just like inventory, all that that we've gone through, this is the same thing. Now, residual value, because this is a term that we're going to have. Residual value are basically salvage value. You're going to see that term also bring up the same thing. This is an estimated value that we believe at the end of the useful life of the asset that it is going to be this price. This is how much we can either sell it for or just basically how much we think it's worth. Again, this is an estimate, means it can change at a moment's notice. Our asset will never ever depreciate lower than the residual value. Okay, that is very good to know due to one of the depreciation ways we're going to get into in just a sec. So remember that we never go below residual value. Okay, depreciation cost or depreciable cost, as we know right here, represents the amount that we will expense over the life of the asset. So basically this is going to be the initial cost, how much it cost us to get it, minus how much we think it's worth. 9 times out of 10, it's probably going to be worthless by the time the life is over. So you're probably going to subtract 0, and the initial cost may equal depreciable cost. That's good, yay, makes life easy. If not, and we know we have a salvage or a residual value, make sure you subtract that from the initial cost. Because again, this depreciable cost is what we're going to basically divide out amongst the life. Okay? This is where we're getting into the depreciation we did in chapter 3, which was straight line. Okay? So, under accounting, this is a pie chart that was back in 2012, which seems really long now, But usually the trend stays the same. Not much changes because, again, businesses are just like us. Once we get set in our ways, it's really hard for us to change. So with this, there are different depreciation modes, and 3 of them we're going to learn. One is known as straight line, which we've already done in chapter 3. Second one is going to be known as units of production, which is going to be similar to straight line, as you're going to see, except there's going to be one difference. 3 is double declining balance, which declining balance we're going to also get into, and that one is the one that you really have to watch out with salvage value. Okay, but as you can see through the pie chart, straight line tends to be mostly the focused one. When we're doing books and basically the accounting method, straight line is the easiest one to grasp, so it's usually the one that's used wide around when we're looking at bookkeeping. If we're looking at tax is going to use probably the red or blue, however you consider, because they use what is known as double declining balance or makers. Usually it's makers, so it's like an other one right here, and you're not going to really get into that depreciation with us right now, and you probably won't get into that probably not until your intermediate accounting, if you're going to take that, or a major tax course, business tax course at a 4-year college. So with us, we're mostly going to focus one, again, refresh of the straight line method. Go and look at units of output, and then we're going to look at double declining. Again, the other, that's probably your pie that's part of the tax. Okay, so back to straight line, because I know y'all love straight line, and again, this is appeared in chapter 3, but we're going to focus with basically how it is again. So we're going to use an example because cars are the easiest ones. We're going to have a vehicle. Again, this vehicle cost us about 20 grand, and it's going to have a residual value, again, or salvage value, depending on how they want to take it to you, of 2 grand. Okay, and it's expected to last for 5 years. Okay, we must calculate depreciation using a straight line method for each of the 5 years. So again, to calculate straight line depreciation, we get this cool formula. So we're going to take the initial cost, which was the 20,000, subtract residual value of 2 grand, and divide it by how many years that we expect it to live for, which happens to be 5. Okay, so if we did all that, you're going to get this. So 20,000 minus 2,000, of course, is 18 grand. Divided by 5 gives us 3,600 per full year. Alright. The thing is, that's for a full year. Okay. That's when we assume that the asset is actually purchased at the start of the year. The problem is, and you should already realize this, companies don't buy everything on the January 1st. I mean, it would be nice if they did, make life easy for us accountants, but they don't. So we actually have to put depreciation by the month it's actually put in for the complete amount of months. Now, we get a little sway here too. Okay, I'll get into that in just a sec. But let's assume for this time around, we have the asset was actually purchased on April 1st. Okay, so since it's purchased for April 1st, it means it's been in use for 9 months out of the year. So if we know 3,600 per full year. We only have 9 months that actually was used. 9 divided by 12, it will give us our percentage that was used during that year, and we just times it by that amount. Helps a lot with that, and I would extremely tell you, pay attention to dates. Dates are very important with this one. So again, we would have taken this and times it by 9 divided by 12, which basically, if we want to put that down to percentage, that's about what, 3/4. So if we look at, give me one sec, because I can't do that math in my head. So times by 0.20. So we're looking at, if we actually did that, the actual depreciation for this example on April 1st would have been about 2,700. So that's the depreciation in year 1. But when it's a partial year, you gotta remember, it will also extend to finish up the 3 months that are missing. So eventually you will get the full year just later on. Okay? So again, that's the only thing. Watch out for dates. Definitely watch out. Okay? And we always have to record the months as they are. Okay? You're going to see this in the homework a lot. So if you're watching this video, check out the homework video that is going to be posted, just to make sure that you're covered on all your bases. Okay? Now, the second one is going to have basically the same formula, but you're going to see a slight difference. So with units of output, we no longer look at the lifespan. Our lifespan is now how much can it output. So when we look at vehicles, the major thing is mileage, so miles themselves. So if we're looking at a vehicle that cost us 20 grand, has a residual value, again salvage value, of 2 grand, so nothing's changed between our things. We do know it lasts for 5 years, but we know also it will last for about 100,000 miles before we decide to get rid of it. With this, we're going to use units of basically production. Okay? So, with our formula on this case, again, it's initial cost minus residual value divided by total units of output this time. Okay? So again, when it's talking about units of output, that's what we're going to divide it by. When it's talking about straight line, it's expected life. Okay? Watch out, because it does get confusing on that part sometimes, because they're so similar to their formulas. So with this is also kind of like depletion, if you ever heard of depletion, but we're going to be focused on whatever the output of the asset is. So of course, buildings, you'll probably not have units of output at all because they don't have an output. But machines, you may be looking at total batches. Okay, the machine's only going to be able to produce so many products. Stuff like that, things that could produce something. But for our example, again, we take the 20,000 minus the 2,000 in salvage value, which again is 18,000, and we divide it by 100,000 miles. Now, for our sakes, this is going to equal out to about 18 cents per mile, which is not bad for a vehicle when we think about it, but this is about the amount of depreciation we actually get to have. Again, this is only going to last for 5 years. So with this, we have to watch out on two things. One is miles driven. Now, of course, vehicles are not going to drive the same amount of miles every year. If they did, life would be good. Life would be awesome. Makes the calculation good. But since they cannot, we're going to always take the miles driven, or whatever the output is, and times it by our depreciation. So 15,000 times 0.18 is going to give you 2,700, and so forth and so on. Okay? So for 5 years, because we only go to 5 years, it only has a life of 5. Again, this is basically starting if we bought it on January 1st. But we go through all the miles. So one thing you gotta watch out is, one, we can't go over 100,000 miles. So if somehow in like year 4 we drove enough to hit 100,000, we're done. Okay? Because again, once we go over 100,000, or whatever the output that we used, it will be lower. The depreciation, or the fixed asset, will be lower than its residual value. So we're stuck at that amount. Okay? But with that being said, every year we're going to have to put in depreciation, and it's just going to be a little bit different depending on how many miles driven. So again, recording depreciation. So you knew I'm going to eventually get you with a journal entry. Journal entries happen. Okay? So straight line, very simple. Every year it's going to be the same. Accumulated depreciation and depreciation expense. Here, units of production is the same way around. It's still going to have our famous depreciation expense that's going to be debited, and accumulated depreciation that will be credited. Here, it's going to be for whatever the output is for that year. So 15,000 times 18 cents gave us 2,700. That's my depreciation. Year 2, my depreciation will then be 4,500. So I would have put 4,500 in year 2. Okay? So nothing really changes in that aspect. Okay? Same account, same depreciation account, because all we're doing is recording depreciation. Okay? So again, if it was year 2, I would put 4,500. 4,500. If it was year 3, it will change to whatever year 3 was. So 30,000 times 0.18 will equal to 5,400. So 5,400. 5,400. Okay? Nothing extremely difficult in that aspect right there. It's just remember to, in units of output, first thing we have to do is calculate the actual cost per mile, okay, or per product, per this. Okay, so you gotta do the formula and times it by whatever output we actually did during the year. Okay, and there's our depreciation. Again, do not go lower than residual value. So the highest, or the max we can go, is right here. Once we're there, we stop depreciation. Okay? Again, if you have questions about this, because this does go a little bit, please feel free to drop a comment or anything that will help you out. Send an email, any questions whatsoever. Okay? So that's the first two. This third one is usually the more difficult version of depreciation that will throw you off just a little bit. Okay? With double declining balance or declining balance, this method really is, depreciation rate is basically twice the normal straight line rate. So it's still acting a little bit. Now if you use makers with the IRS, that's a whole different ballgame. So be glad you're not doing that. Here, this is the simplified version of double declining. Okay, so we're going to take the same example that we done. That $20,000 vehicle for 5 years with $2,000 residual value. And now we have to determine the rate using just a double declining. Okay, so your first job here is you're going to find the rate. Okay, finding the rate is taking basically a year and divided by the useful life. So 1 divided by 5 says that every year, technically it's 20% of that gets depreciated. That's our rate. But for us, in double declining, all we do is take that rate and times it by 2. Again, this one's a little bit going, okay? So, best way to do this when you're looking at double declining. Now, true, we're going to have software in the real world, but not always is the case. Excel is a big one that is good to use on this. What we're going to basically produce is this. We're going to create the chart and we're going to focus on our years. Okay, so we got years 1 through 5. Now again, if we have partial years, you may have another year because we're finishing out whatever's going on. Okay, just how many months. So again, we're assuming we bought this on January 1st. Again, I would tell you to definitely check out the homework. Homework's very good on giving you different dates. Okay, so first thing, book value. What is book value? Okay, book value in itself is the initial cost minus the accumulated depreciation. Okay, so y'all remember accumulated depreciation? That is the contra asset account that holds all the depreciation for our assets. Okay, we're going to look at basically our vehicle. This method is not going to be using residual value at all. Okay, we're going book value. This is why I would strongly encourage anytime you see this, make this chart. It just helps you out and it's a good way to get in pattern. Again, notice how in previous videos and previous chapters I travel around the T-chart. Here I'm trotting around this basically chart for double declining. So in the first year, book value is my initial cost, which was $20,000, and minus whatever the accumulated depreciation. Well, we haven't depreciated yet, so that's basically 0. So your first year will always be the initial cost. Okay? Then we're going to times it by the rate. So again, I took 1 divided by 5, which is 20% for each of these years, basically the straight line, and divided and basically times it by 2. So my rate is going to be 40%. Okay, so 20,000 times 40% basically gives us $8,000. Okay, that's our depreciation. Now you're going to notice sometimes businesses love to use double declining because it gets rid of most of the cost to expense quicker. Okay, in the early years. In the later years, you're going to notice it's going to drop down quite a bit. So now we look at book value for year 2. Book value again is initial cost, so my $20,000 minus accumulated depreciation. Well, now I depreciated $8,000. So basically it's going to be 20,000 minus 8,000, which is 12,000. Okay? Again, times it by our rate, and we come out to 4,800. Okay. Cool part here is if we keep with the book value of that year, our accumulated depreciation is going to follow along. All we're going to have to do with this chart is take now this current book value and subtract out the depreciation of that year. So if we do that, you're going to run into 7,200. Go through the same steps. Double declining is all about repetition. Okay? But problem you're going to run into is residual value. Okay? Notice here. Let me see if I have anything in this one. Okay. So we cannot go beyond 2,000. That's what our salvage value is. So in year 5, supposedly our last year going on, we still get to depreciate for the full year. But notice this. 2,592. Now if you times that by 40%, it will actually lower it beyond 2 grand. Okay? So that doesn't help us out, because again, we can't go over. So in the year that it's going to go below residual value, we can only take what gets us to there. So basically, this, we have 592, that gets us to 2 grand. Well, of course, 2,592 times by 40%, that's $1,000. Well, definitely if I subtract $1,000, a little bit over 1,000, by that, it's going to be lower than 2 grand. So I'm only allowed to take what will get me to the salvage value this time. So that one's going to be the little trick part. Just remember, again, we are not allowed to go below residual value. Okay? Now, does that mean you could still have value in the asset? Yeah, and double declining. If the asset was zero salvage value, well, we've already hit 5 years. So it's going to have value still that is no longer going to depreciate out. That happens. It happens more than you think. But here, our main focus is just not to go below residual value. Okay? So you do it for the exact life that we have it for. We have 5 years, 10 years, 20, 25, set hut, hike. It still works. Okay? So, again, our summary. Here's our summary of depreciation methods. 1, straight line. Again, its useful life is basically years. Same thing with double declining. It's all about years. Units of output is all about units of output. That one is defined in its name. Depreciable cost, again, it's cost less residual value on both straight line and units, but it's declining book value on double declining. Again, just using the same thing that we've done. Depreciation rate, again, we're looking at straight line rate. This is straight line rate times 2. So again, 100% divided by useful life. So 1 divided by how many years we have. This one's the only difference is still cost minus residual value divided by total units of output. Again, when you look at the formula for straight line, it's best just to take cost minus residual value divided by useful life. It's the same thing. Okay, that's a little bit easier. This one's going to be constant. This one's variable depending on the output, mileage, and all that. And this one's declining. So again, it declines very fast. Okay, so it's basically used for if we need a lot of depreciation in the first year, and then move on. Now, again, books on this one, if you're going to change the depreciation method, you definitely need to basically give notice to like the IRS or the SEC, because you can't just keep flip-flopping on depreciation either. Basically, if you're going to do straight line or double declining, you have to let your investors know, and then you can't just flip. Okay, so this asset's going to be this asset's going to be that. The only one that allows you that is anything that can actually produce output. Okay, I can't go in between years, like the vehicle started off as straight line then switch it to units. No, it has to stay with that method for that asset. Okay, so let's do this again. We've done a big repair, or we've done something that made management say that the useful life is going to get extended. Okay, again, we're going to be using our vehicle. This time it had 3 full years of depreciation. So about 10,800 has been depreciated so far. And as you can see, here's our book value. Now remember, our book value is our initial cost minus accumulated depreciation. It's not dealing with residual. Okay, so right now we're just using straight line method. We're not going to get into too crazy, but we're going to assume management has updated their estimates and they believe that now it's going to last 4 more years. So in total 7 years. Well, we've already depreciated 3 of those, so we really have 4 more years. And now the residual value is only $1,000. So they changed the residual and they changed the life. How do we calculate this? Okay, well, again, we're going to take the book value, which happens to be 9,200, and minus what is the new residual value, if there is a new one, of 1,000. Now, if they didn't revise this and it was still 2 grand, you subtract out the 2 grand. Okay, but since they give us a new value, which most likely they are going to, if they're going to extend the life, we subtract out again the salvage cost. For us, once we do that, we get 8,200, and now this is the one that gets spread out for 4 years. Okay, you're going to notice this. If we extend time on any asset after we're done with this, the depreciation per year should be lower than the original. Again, life got extended. Okay, and always remember this. It is a going forward rate. This is why we use book value. We cannot change the past. Past is what it is. Okay, so this asset has been depreciated by 10,800, no matter what. Okay, I can't go back and now say every year I'm going to recalculate to 2050. No. This is going forward. This is why we use book value instead of initial cost when we revise. So be aware of that. Watch out on changing, okay? Again, be aware of partial years. So I don't have any really big thing here, but again, watch out on this. So in reality, organizations do not purchase on January 1st. So just like my note, watch out, and if it's only been used for so many months of the year, that's how much we depreciate for in that year. Normally organizations, since they buy all crazy, the IRS and the GAAP and the SEC allow us to do what is known as mid-year, which basically we can assume all the assets acquired were acquired in the middle of the year, even though it wasn't. So sometimes this helps, sometimes it doesn't, but it does make it a little bit easier for depreciation. You just have to declare that to the investors that all assets are recorded as mid-year. Okay, so basically half of the depreciation would be in full year. but you do again have to watch out for dates. Okay? And I'm not like saying the ones in Raiders of the Lost Ark with Indiana Jones, because those were poison. Here, we're trying to help you a little bit. Just watch out for those dates. Okay? Alright, so we're going to get into now journal entries that go with getting rid of an asset. Of course, what eventually, as all businesses have to do, is get rid of an asset. So, we're going to dispose basically a $25,000 asset. It's been fully depreciated, and we need to remove the equipment. It's no longer needed for our books. So when we do this, we have to get rid of basically the equipment itself and the depreciation that's involved. Again, we no longer own the equipment. It has been scrapped, and so we're no longer have basically the ownership of the depreciation either. We already basically expensed it all out. It's been good to go. So when we do this journal entry, basically it's kind of like a reversal of the natural course of things. Again, both of these items are going down. The product is gone. So accumulated depreciation is going to be debited by $25,000 because it went down, and equipment will also get credited. Again, we lost ownership of it. We basically got rid of it. We sent it to the junkyard in the sky. So now it's no longer ours. We must lower our equipment by whatever amount it was. So it gets credited by the 25 grand. Now, let's suggest this. That's the easy one. Fully depreciated, it goes away. Well, sometimes that doesn't always happen. Sometimes we may sell a product, we may actually remove it in different ways. So if an asset is not fully depreciated at the time that is known to be scrapped or gets sold, we're going to have to do partial depreciation. Okay? So this could be as easy as we sold in December. If that happens, then we had it for the full year. But again, that doesn't always happen. Okay? So with this case, we're going to use this example. Okay? We're going to take an equipment that cost us about 6 grand. Okay? Is depreciated on straight line at a rate of 10%. So you're probably looking at 10-year equipment. That's all I'm going to basically tell you about the life itself. In addition, assume on December 31st of the preceding year, okay, the accumulated depreciation of the asset is $4,750. Okay, the asset is then discarded on March 24th of the following year. We need to do 2 journal entries. Okay, first one is to update depreciation. It has to actually be to the full depreciation, because again, we get to recognize the expense involved. Okay, so, and then the second one is basically getting rid of the equipment. So first journal entry that we're going to look at is how do we update depreciation? Well, this is on straight line. So again, if you took 6,000 minus 0, or basically 1%, times how much we actually used it during the year, so 3 out of 12, because we used it all the way basically till the end of March, even though it's the 24th, basically the whole month got used. Our calculation shows that expense for that year is going to be 150. So again, we do our regular depreciation journal entry, adjusting entry. Okay, so again, depreciation expense, accumulated depreciation. Alright, so again, take your initial cost, times it by 1%, times it by how many months it was used during there. That's good when it gives us the rate. Okay. Again, calculate the rates, helps you out. This is double declining. Just as an example, double declining. Remember, we take 10%, times it by 2, 20%, and you're going to have to watch out a little bit because we're going to have some kind of book value. Okay? But just getting used to double declining. Anyways, after we have figured out the depreciation in that year, we're going to have to remove the equipment. Okay? So again, it's going to look similar as this. But remember, this is accumulated depreciation. Okay? So, we've already known that it's gone 4,750. We need to add this accumulated depreciation to what's already been depreciated. So, add another 150. You're looking at 4,900. That does not equal to 6 grand. You have a little bit left over. So, you're going to have this kind of journal entry. Let me show you. First off, we have to remove the accumulated depreciation. Again, you debit for the amount of depreciation that has occurred up to the date of removal. For this being disposal. Okay. So, 4,750 from the prior years, and plus the 150 in the current year that we got to depreciate. Okay. Next, your equipment, you have 6 grand right there. It's always going to be the initial cost. Okay. Again, we don't change this unless we have a repair, then we get to mess with, but we're only dealing with the simple version. Okay. We're not going to get into that until you're intermediate and so forth. From here, so these two accounts I will tell you always do, kind of following this, but you're going to notice the difference. Okay? So to get the loss of on disposal, you're going to have to record it, basically taking whatever the asset is. So, alright, don't have it there, but whatever the initial cost is of that asset, so happens to be 6 grand, and you're just going to subtract basically how much accumulated depreciation. So, this is going to equal our loss on disposal. Notice, what is it kind of really reminding you of? Another formula that we already know when we're doing loss on disposal. That was book value. So again, book value, go all the way up here. Initial cost minus accumulated depreciation. If we remove a product before, or an asset before it's been fully depreciated, it's basically we're losing whatever the book value is at that time. Okay? So selling. Selling is a little bit different on the journal entries. Pretty much because we've got money coming into us. We sold it. So this is going to change it up just a little bit. So let's use this. We sold a fixed asset, very similar, again, to disposing, except we collected the cash. So, we're going to assume this time a piece of equipment cost about $10,000 and is depreciated on a straight line rate of 10%. Again, in addition to this, assume on December 31st of the preceding year, the accumulated depreciation of the asset is 7 grand. The asset is then sold on October 12th of the following year for $2,800. We need to, again, do our two entries. Same thing as disposal. first entry is always going to be the depreciation. Second entry is going to be the sale. Okay? So, alright. Was making sure on something. I scrolled a little bit too far. Anyway, so first one is the depreciation. Again, easy way here is calculate how many months we had it. Okay? I want to tell you this. You're going to calculate for the whole month of October by accident. Here's the thing. This is the rule of thumb. So, if we look at the date, and the date is basically going to be greater than 15. Okay, so greater than the 15th date, we get to take the month. If it's the other way, if the date, so let me put that date, alright, let's put day. Day is greater than 15, so we'll look at the day, we get to take that month. On the other hand, if the day is less than 15, we don't get to take the month. Okay? Now, so that's important right there. Okay? As we see, this was in October, so we had it in October, but we did not reach that 15-year threshold. And again, this is a law that's basically for GAAP and IRS. So, since it's less, we're only going to be able to take 9 complete months. So again, we get to do our depreciation, so 750, and that's going to be our initial cost times our rate times 9/12. Again, we're only allowed to take 9 months. If this was on October 16th or 17th, we actually get to take 10/12. So dates are important. Again, dates are very important. So I would tell you to write that down so you can always check out on that. That is basically the rule of thumb. It's kind of like rounding. We get around our months. Okay? So again, when we're dealing with the sale, first off, first journal entry we should always do is the cash that we have received. Okay? So here we sold the asset for $2,800. That's awesome. Way to go. Okay? We're going to calculate accumulated depreciation. Again, this is going to be our debit, and that's going to be wherever the preceding years were. So the accumulated depreciation. So 7 grand plus whatever happened in the current period. So plus 750. Let's see. Oh, didn't get the right way. Oh well. So the next one is again equipment. Equipment gets credited. And you're basically going to find the difference. Here, it's either going to be a gain or a loss. Basically, it's sales price minus book value. Okay? Again, book value is the difference of initial cost minus accumulated depreciation, and then basically you find it from the sales. Here, I will tell you this. Do these 3 accounts first, always, and then you can figure out gain or loss. Okay? Here, it was actually a gain because if I added cash and accumulated depreciation, it'll be like 10,550. That outweighs our credit of 10 grand. So the difference is 550. That has to increase the credit side. Or again, you can do this. So let's say this way. Let's say the asset now sells for $1,000. We need to record the loss of $12,500. Why is that? Okay. Well, here, again, here's the formula that we just used. But here, if I take 1,000, my sales price, minus the 10,000, subtracted its accumulated depreciation for book value, we're going to find out that this is basically going to turn into a negative number. Okay? Again, this book value basically outweighs our sales price. Okay? Again, you're going to notice that in many ways. If this was only 1,000, that's 8,750 on this side, 10,000 on this side. We need to increase this side to make it balance. So a loss is a debit, a gain is a credit. So gotta remember that also. Okay. Now other types that we actually get that basically, if anything, you have as multiple choice, because we're not going to go too heavily deep into these, is one that uses depletion. Depletion's only on natural resources. So oil, coal, diamonds, gas, natural gas, all those. And it's going to be basically units of production. We're going to estimate how much this mine or this gas pocket is going to actually produce for us. And every year we get to depreciate by that amount. The other one that we usually see in depreciation terms is one for intangible assets. Again, these are stuff like goodwill, patents, copyrights, that sort of thing. Amortization is basically the term that we use for those. They work the same way as straight line. Okay? They're going to have so many years that that patent or copyright is good for, and we basically get to take a little bit as we go. Okay? So again, natural resources is depletion. It's just the same thing as saying units of output, but they actually use depletion. Intangible assets is amortization. Anytime we're working with fixed assets, it's depreciation. But they're all basically known as the same thing. It's just expensing out an asset for basically for its useful life, letting us take each year the amount we've actually earned to use. Okay, so this chart is actually pretty cool. This gives you a little bit more information of what some of these intangible assets are. So this is just extra info. I mean, you're more than welcome to read this and go through. Again, this one, the last one, goodwill. Now I'm not talking about the company goodwill, but goodwill is something you're going to get into if you're an accounting major, into intermediate accounting, on how to calculate this and how to actually figure out the value to move on that one. So that one's actually a cool one. I would say just look into that if you're an accountant major, because you're going to experience that one. Okay, so let's look at a little bit of the problems. Again, we're going to basically take a little bit as it goes. So problem number 1, we have on March 31st, 2015, Flower Corp purchased equipment for $104,000. Its estimated residual value is $8,000, and its estimated useful life is 8 years. Okay, so again, simple thing is that it's going to ask what is the depreciation expense for the equipment for the years 2015 and 2016, assuming that Flower Corp is using straight line. Alright, so watch out for this. Okay, first off, let's do the formula. Formula is, I don't think I have it anywhere, so we're just going to type it out. No, I have it. Cool. So right here, this is the classic formula. Notice that it's a little bit extended for 2015. Here we again take our initial cost minus the salvage value divided by 8 years. Watch out. Again, this was done on March 31st, 2015. The classic mistake with straight line is to take it as the regular one. We've done the formula and we assume that's 12 grand. That's good if it was used in the whole year. So the answer here is 12,000. Okay? Because we had it for a full year. Here we didn't. So we need to take the months that we actually had the product. We didn't actually really receive this product or basically put it in use until basically April 1st. Okay? Again, even though it says March 31st, we had it for 1 day. Okay? If you look at days, again, it's basically less than 15 days of that month we physically had it. Okay? So we're not allowed to count that month. Basically, it starts on April 1st. So it's really 9 months. So starting in April and moving on. So times that by 9/12, and the actual answer is going to be 9,000 in the first year. Okay? So you have to watch out on dates. First year is always going to have that trick. Second year, if it's the full year, we didn't sell it in the second year, which we shouldn't, we actually get the full amount. So we actually get to use the formula. Just watch out for the first years, especially if you don't see January 1st up there. Part B. In the problem number 1A above, what is book value of the equipment? Well, here, let me see. Alright, so I have a little bit of things going on here. So, book value, I'm trying to see what else I have covered. There we go. There we go. Alright, so book value, again, is the initial cost. So it cost us $104,000 minus accumulated depreciation. So basically, if we're just looking at the end of 2016, we're just going to take 9 grand minus 12 grand. Nothing more, nothing less. Okay? So, very easy stuff going on right there. Next thing. So, that's book value. That's straight line. Okay? What if they use double declining for those years? So, part C. Double declining balance. Okay? So, starting off, always do our chart. Have our year, book value, rate, and depreciation. We're only looking at 2015 and 2016. Okay? So starting out, we're going to find what 1/8 is. And 1/8 is about 0.125. So first off, find your rate. 1 divided by 8 equals to 0.125. Since this is double declining, times that by 2 will equal our double declining rate, which is a quarter. So 0.25. Alright. So again, book value in the first year starts with the initial cost. Okay. The rate for the first year will not be the 25%. The reason behind this is, again, dates. Okay, we have 9 months out of 12, so we're going to have to times this rate by 9/12. So you have to watch out for that. Again, dates are key. So for this, depreciation in 2015 was actually 19,500. Okay. Again, using the chart, we'll take book value minus the depreciation, gives us a new book value of 84,500. Now, since we had it for the full year, we get to take the whole rate. So we times it by a quarter. and that gives us to $21,125. Okay, so this is my actual depreciation in those years. Again, if you like to see in red, there it is in red. So straight line rate is 1 divided by useful life. Again, this is 12.5%. I did it in decimal form, okay, up here, but then take 12.5% times by 2 equals 25%. If you want to keep it in decimal, still you can do 0.25. Comes out the same way, okay? Alright, so let's look at problem number 2. We got 2 problems, and this one just basically goes over definitions. All 3 depreciation. Again, not much journal entries. Your homework is going to have journal entries, but this one we're just looking at depreciation. So definitely check out the homework while you have to if you're in the class. But if you're just watching these videos just for the pure fun of it, make sure you check out the homework video that goes along with this, as that gives you more examples of the journal entries. So problem number 2. A machine was purchased on July 1st for 2015, on 2015. So we made life easy on this one. We don't have to worry about the dates because it was purchased at the beginning of the year. Okay, for $260,000. The machine has a residual value of 20 grand and useful life of 5 years, or 24,000 hours. Determine the annual depreciation expense using the following methods. Okay, so straight line. Straight line's the easy one. Okay, so again, straight line takes our initial cost minus the 20,000. So we're looking at 240,000 divided by 5 years. So right there, that tells us 48,000 is going to be for that year. Okay, so straight line's a little bit easy. Again, as long as we got all the items, makes life easy for us. Units of production, it's going to run in the same pattern, except you have to divide it, instead of by years, by how many hours. So we find out that first we have to do this calculation of the initial cost minus salvage value divided by whatever output we're heading towards. Finds out that's about $10 per hour. Then we take that 10 bucks and times it by 5 grand. Okay, so 50,000 is our depreciation in that year. Okay, in 2015. Remember, this is going to change on the years, so that should have been 2015. Okay, double declining. Double declining we have to watch out for. So again, you have to find the rate. So our rate, 1 divided by 15 equals 20%. Have to times that by 2 gives us 40%. We take the initial cost because this is the first year, so basically our book value, and times it by our rate since we have a full year, and that depreciation is 104,000. So again, as you can compare these, this one's all variable, so this one's a little bit harder, but you're going to always see that basically we're going to have a greater depreciation and declining, and it's usually going to be double. Not bad, a little bit. Let's see, 48,000 times 2. It's close, not that great, but it's the rates. So times it by 40%, boom, you're done. It's good to go. Okay, so watch out. First step with double declining is always finding out the straight line rate. Times it by 2. That's what you get times by. But keep careful of the dates. Okay, so that's it for depreciation. So that's it for Chapter 8. That's all about fixed assets, and we're good to go. So, again, thank you for being here for another exciting chapter of 2301 accounting. And again, if you have questions, please put them in the comments below. I will see those, and I will get to you on those to help explain even more. If I have lots of comments, of course, I'll make another video to address all those comments in one go for. So, this is Professor Naragon signing off, and we'll see you for the next exciting chapter of Accounting 2301.